Welcome back, class. This is Chapter 11 video, and we're going to talk about some of the things that are involved with reporting and analyzing equity. And in this case, we're looking at some of the advantages of a corporation and the definitions, like we began with in class the other day. A corporation basically is an entity that's separate from owners and basically has its own individualized existence apart from the ownership. And because of that, a corporation is very different from a proprietorship. In a proprietorship, once the owner's involvement ceases to be a part of that business, then that business does not exist as it once did. An owner can sell the business, but if an owner decides to retire or liquidate the business, that business will no longer exist. So if the owner dies and is in a proprietorship, unless that business is sold, there's no way it's going to continue, and whatever it continues as after its sale will not be the same as it was before. Corporations continue on regardless of what the ownership structure looks like. So that means in a corporation, the advantage is this separate legal entity structure provides a couple of things. One, limited liability for stockholders. And if you're an owner of the business, you cannot be held liable for the debts or the actions of the corporation. The ownership is very easily transferred between your shareholders, so a new owner can come and go at will by basically selling or buying any shares of stock. That also means that the corporation is going to have a continuous life, that it will continue to exist apart from its owners, and it will no longer be connected as the original founder or owner was with the business, so it will continue to have a life of its own. A good example of that would be Ford Motor Company. It's no longer owned by the Ford family. It was established by Henry Ford, but basically as a corporation, it's publicly traded, and it has a life of its own separate from that ownership. There's no mutual agency for stockholders. So if you're a stockholder, you're going to have no ability to bind the corporation into a contract or an agreement in any way. It's easy to accumulate capital. That's a very attractive part of being a corporation. Two disadvantages that they identify here. One is government regulation. A corporation is going to be bound by the state's requirements for incorporation, and that means that you will likely have to complete a charter application and include some documents, legal documents that an attorney will need to provide you with, something like an articles of incorporation or something of that nature to file with the state. And so those documents will cost you some additional money. Other than a proprietorship doesn't have to file those. A corporation will also pay taxes as an individual. Because it is individually identified, it pays its own set of taxes, and those taxes are basically as an individual existence. Now, once that net income is shared out of the business, the corporation pays those taxes and shares net income with the shareholders. When it shares that income, the shareholders will also be taxed on it, and that's what they call double taxation. The organization and the management of the business, I mentioned a moment ago that incorporation involves charters from the state and articles of incorporation, and those documents are prepared by legal counsel, and usually there are some additional fees that go along with those. And so that application process can be complicated and it can be expensive. Also, when you're organizing a corporation, the organizational expenses that you're setting up the corporation, you're spending to set up the corporation are costs, but you're going to deduct those. You're not going to capitalize them. You're going to deduct them directly as expenses. So as you pay them out, you're deducting them as expense. The management of a corporation is different as well. The shareholders will elect a board of directors, and the board of directors will appoint the executive officers, and those officers will hire the people that work in the business. So, professional managers. There are stockholders are not going to be managers might be stockholders, but stockholders are not going to have a right to become a manager unless they're hired by the corporation. So they're not going to be automatically involved in the management of the corporation. As a stockholder, you have a right to vote at an annual meeting. If you own common stock, you can sell or distribute the stock to whoever you please. You have a preemptive right to purchase as many shares as necessary to keep the percentage of ownership you have. The example here is somebody has a 25% share of a stock. Well, when the corporation issues additional shares, that person has an automatic right to buy up to 25% of any new stock that's issued so they can maintain that 25% ownership. They receive the same dividend on all stock, and they share in any assets that may remain after the corporation is liquidated. Stock certificates look like this. Sometimes issue these. Basically, it's proof of ownership of whatever shares you have. A registrar, a transfer agent, is going to maintain a list of shareholders of record at any given time. And so they're going to keep up to date with whoever's buying and selling the shares of stock. And on the date of record, they're going to identify who the shareholders are on that date. The charter or articles of incorporation is going to identify how much stock is authorized, and they're going to identify exactly what you can sell. Authorized stock means this is the number of shares I can sell if I choose. Many times the authorized shares are much higher than what is actually issued and outstanding. A corporation can sell stock directly, and usually this is in a privately held corporation. But if you're a publicly traded company, it's more likely that you're going to sell those shares of stock through a brokerage or through an investment banker of some kind, where they purchase the initial public offering or maybe even the offering of those shares that you're issuing, if they're additional shares, and then resells them to the public. The market value of stock is basically what's going to be paid for the shares of stock on the exchange. And those are all the market value is based on expected future income and the growth of the business. Classes of stock include both common stock and preferred stock. We haven't talked about preferred. Common stock is going to be the automatic first stock issued. So every corporation has common stock. Not all corporations will have preferred. We have this par value on stock, which is basically a fairly arbitrary value, and it's fairly low. So when the par value is determined, it's going to establish a minimum legal capital amount, which is the least amount of capital that the company can have. And sometimes states require a minimum legal capital amount. Now, you can issue no par value stock, and what that means is the stock you're issuing, you're not going to declare par value, and this would work if the state where you're incorporating does not require a minimum legal capital. Stated value stock works a lot like par value. The difference is the stated value per share is going to be whatever the minimum legal capital amount is. So that's how those would work. Now, when we look at selling stock itself, if we sell it at the par value, we're not going to have any additional paid-in capital. But if we sell it above par, which happens quite frequently, we'll have an additional paid-in capital and added to whatever shares of stock we already have. Retained earnings is the other piece that's in the stockholders' equity section. If you issue par value stock at par value, it's a very straightforward transaction. You debit cash for the amount of the sale of the stock, and then you credit common stock, whatever that value is. And then if you issue that stock and you receive more money than par value, which is typically what happens, you're going to record the amount of cash you receive for the shares of stock that you sold. Then you're going to record the common stock value at par value as a credit. And then you're going to calculate the difference between those two numbers to get the paid-in capital in excess of par. Basically, it's whatever was paid above par value for those shares of stock. The paid-in capital in excess of par is shown here. You have the initial common stock and you add that in along with retained earnings. No par value stock, you're never going to really have any value above whatever you receive. Whatever you receive is what you're going to record the value of the stock at. So in this case, they sold 1,000 shares of no par value common stock at $40 a share. There's no paid-in capital in excess of par because there is no par. Now with stated value stock, it is possible that you have additional paid-in capital. So here you receive cash for stated value stock. The stated value stock is $40 a share. You receive $50,000. So you record a credit for the value of those shares of stock, and then the difference goes into paid-in capital. You can also issue shares of stock for non-cash assets, and if you do that, the basis for the transaction is in the value of the non-cash asset that you're acquiring. So in this case, you identify the value of the land, and then you decide, or you've negotiated how many shares of stock you're going to offer for that, and you record those shares of stock at par value. So the credit here of $80,000 is a par value of those shares of stock. The difference is the paid-in capital in excess of par, and you're going to show that there. You can also give shares of stock to promoters during the startup if you want to pay some organizational expenses with stock. So what you will show is a debit to the organizational expenses for whatever those expenses were, and then the negotiated number of shares you're going to issue here times the par value to show the par value of $9,000 here. So you had costs of $12,000. The difference, the $3,000 over the par value, is going to be paid-in capital in excess of par. So we get to dividends, and if you're looking at cash dividends, basically the board is going to declare dividend. Then you're going to be concerned about the date of record. In other words, who owns these shares on this given date before you make the payment. So you declare the dividend, you identify who owns those shares of stock, and then you make the payment. The payment for a cash dividend is very straightforward. You debit retained earnings and credit the common dividend payable on the date of declaration. On the date of record, you don't do anything, but on the date of payment, then you're going to debit the payable and credit cash. It is possible that you will issue cash dividends if retained earnings are not enough to pay them. If you're issuing dividends when your retained earnings won't cover it, you'll create a retained earnings deficit, and it'll be shown on the equity section of the balance sheet this way. You'll have the common stock minus the deficit to arrive at the total stockholders' equity. Now, there's a difference between that and a liquidating cash dividend. This is not a liquidating cash dividend, even though it reduces retained earnings to the point where there's a deficit. A liquidating cash dividend is when you're liquidating assets of the corporation, and that will require a debit entry to capital accounts instead of the retained earnings when it's declared. Stock dividends are basically issuing shares of stock instead of cash, and so in these cases, you're going to identify how many shares of stock you're going to issue for that dividend, and based on the size of the dividend, will determine what your treatment is in accounting. So for a small stock dividend, that is the value of the additional shares issued is less than 25% or 25% or less of the previously outstanding shares, you're going to basically say, I'm going to record it at market value, and then whatever difference I've identified will go into paid-in capital in excess of par. A large stock dividend will never be recorded at market value. It will always be recorded at par value or stated value. So with a small stock dividend, it could look like this, where you debit retained earnings, identify the par value here in common stock for the dividend, and then whatever the retained earnings debit amount was, or the dividend amount, minus the par value is going to be paid-in capital in excess of par. With a large stock dividend, that's never going to happen. It's going to be basically recording that transaction at par value. So if you look at it here, this is the date of declaration for a large stock dividend. You're going to debit the 30,000 here, which is the par value of stock times 3,000 shares, whatever that is. So in this case, it looks like $10 a share because you got 30,000. A stock split is where a corporation basically splits stocks, and what this is going to do is reduce the par value of the share of stock individually, but it will maintain all shareholders' present percentage ownerships of the business. So if you do a stock split and you issue additional shares, the reason you might do that is to reduce the cost of the shares of stock in the market to make it more approachable or affordable or whatever. They use Apple as an example here, and if you've ever looked at their shares of stock, you'll know that their values have traditionally been high. And so that may be the reason they did a 7-for-1 stock split. Preferred stock operates differently from common stock. It's preferred stock, meaning that it gets first treatment on dividends. When you sell it, you have a preferred par value, and it's going to work just like common stock. If you receive more than the par value, you show the difference as paid-in capital. Then if you go to the equity section, you're going to see entries that are separate from common stock related to the preferred stock. One of the things that preferred stock does is it receives many times preferential treatment for dividends. Well, it's always going to receive first treatment for dividends, but there's another factor that might happen. It depends on how they structure it. This idea of cumulative preferred stock means that if for some reason in one year the board passes on a dividend and doesn't issue it, the next year they issue a dividend, they have to go back for preferred stock and pay the previous dividend in addition to the current before they distribute anything to the common stockholders. It may not be that way, though, because there are cases where you have non-cumulative preferred stock, and if that happens, if the board should skip a dividend in a year, preferred stock is treated just like common stock. There's no difference in the treatments. So participating preferred stock, well, you can have that. Most preferred stock is non-participating, which means stockholders what this means is the non-participating means once the preferred shareholders get their preferred dividend, that's all they're going to get. If you're a participating preferred stock, you get your preferred dividend in addition to additional participation and extra dividends that are left over for common. So you have almost a double dipping that's going on here. So participating would mean you'd receive 2 dividends instead of 1, because in the second case, you're sharing with the common shareholders in their dividend. You'll issue preferred stock for a number of reasons, but it operates a lot like a bond, and so they have a specific stated value or stated return. So many times preferred stock will be issued and identified by a percentage. So you may have 6% preferred stock. And that way it would work a lot like an interest payment because that dividend would function like an interest payment. Okay, so the next thing is treasury stock. If you buy back shares of stock, it's going to be called treasury stock. it is entirely possible and sometimes likely that a corporation will buy back shares of stock if it sees the value of the stock declining too much and wants to perhaps shore up the price. It will buy back some of its own shares. The transaction for that would be a debit to common stock, treasury stock common, and you'd identify it at the price that you're paying for it to bring it back in the credit to cash. This is how it would be reported in stockholders' equity if you had treasury stock. Now, once you have it in the business, once you buy back your stock, you can resell it if you wish at any time. Now, here it looks like they've resold it at exactly the amount that they paid for it. So there's not a gain or loss on the treasury stock itself. So that would just be simply, instead of par value, though, here you're going to record the value of stock at the cost that you originally paid for it. So in this case, it's $11.50 a share, and what you're doing here is actually recording that cost per share as the treasury stock common. So you're adding it back into the equity section. But once it's treasury stock, you're always going to track it as treasury stock. So if you sell it above cost, which is hopeful, that's what you want to do, you take the cash in for whatever shares of stock you had. The treasury stock common is going to be shown at the value that you paid for it the first time, the $11.50 a share, but you receive $12 a share now, so you're getting an extra $200 on those shares. So you show that as paid in capital. It is possible to sell it below cost. If we do, then you're going to basically have a paid in capital that's a debit that will reduce the value of that treasury stock. And by the way, once you purchase treasury stock and you sell it, you're going to record paid in capital specifically for treasury stock. You're not going to mix in paid in capital. You're not going to mix treasury stock and common stock. Okay. And then when you report equity in retained earnings, the thing to know is that there may be cases where a business sets aside specific amounts of retained earnings for future projects. And when they do that, we're going to call that an appropriation of retained earnings. So if there's a major building project coming up they want to set back some money for, that will be through appropriated retained earnings. If you do any prior period adjustments, you're going to show that in the statement of retained earnings. A prior period adjustment occurs if there's been an accounting error or a material misstatement in one of the prior statements that you're correcting. And those would be simply adjusted here. That's a prior period adjustment, which is different from changes in accounting estimates. And if you change an accounting estimate, like depreciation, that only affects the current and future periods. You're going to show it differently. Okay, price earnings ratio. We've talked about this some, and the earnings per share. Earnings per share are simply the net income divided by the weighted average common shares outstanding. And the price earnings ratio is that earnings per share amount basically divided into the market value. Take the market value on top, divide that by earnings per share. What the price earnings ratio is telling you is how valuable those future earnings are in the market. And then you have dividend yield. Again, you're going to take the annual cash dividend per share and divide that by the market value per share. And that'll show you what you're actually yielding on your dividend. So book value per share, you're taking the book value of the company and dividing it out amongst the number of shares outstanding just to show whatever book value is distributed to all the owners. Okay, that really does it for Chapter 11. I look forward to talking with you in class and seeing you then.